All right, guys, let's quickly take a look at tomorrow morning's RBA policy decision coming up at 5:30 UK time. Now, for those of you who've watched the week ahead video, I just don't see this thing creating any meaningful volatility for us tomorrow, because I don't think the bank will be pressured to make any meaningful changes in their statement going into tomorrow's meeting. You know, the data that we've had recently has been mostly mixed. We'll look at that in a second. To be fair, you know, inflation, things like inflation and labor does potentially shift the pendulum slightly more towards a hawkish risk than a dovish risk. But I don't see them wanting to give up their optionality at this stage, because let's face it, these guys don't have a clue where inflation is going, right? We've seen this in central banks across the board over the past, what's it been now, 2.5, 3 years. The general direction has been lower, but in terms of how fast we get there, these guys are constantly adjusting their forecasts and their projections just based on what the actual data is showing us. And they've been consistently wrong in that. So with all of that said, I just don't think the recent data that we've had after the May meeting forces them to shift incrementally more dovish or hawkish. I think they can just allow themselves more time. They can just kick the can down the road, basically, and that's what I would expect them to do tomorrow. So, as always, when we look at incoming policy decisions, it's worth understanding what the markets are pricing in heading into it. And the markets are pricing in with a very close to 100% probability a hold from the bank, which looks to be the most logical outcome tomorrow. I mean, there's not even a basis point worth of easing price. We know that the first full cut is priced only by April next year, and there's about 16 basis points worth of easing or quote unquote cuts priced by the end of the year. Now, what is the recent data? What does that look like? And is there anything in that data that could potentially see the bank shifting slightly more dovish or slightly more hawkish based on their prior communication? Well, before we get to the actual data, let's look at what they said last time around. Like last time around, they said that they were concerned because inflation remains high and it's falling more gradually than what they anticipated. What they did at the prior meeting, they already pushed back when they thought inflation would be hitting target by about 9 months, if I recall correctly. The central forecast, based on the assumption that the cash rate follows market expectations, are for inflation to return to target of between 2 and 3% by the second half of next year. So they only think inflation will get down to their target within a year's time. That's a lot of time, right? So they've given themselves a lot of scope on when they want to see, when they expect inflation to move back towards target. Apart from that, last time around, they said that the CPI grew by 3.6%. Remember that number, down from year over year to the March quarter, down from the 4.1% over the year to December, right? So that's important, because when we look at the numbers in a second, you'll see why I don't think that the prior number, even though it was hotter than expected, should really freak them out at this stage. They also spoke about, growth in unit labor cost also remains very high. You know, labor cost was something they spoke about last time around. We'll look at what that recent data showed us, which again is, in my reason, something that we shouldn't be too concerned about, or that hasn't really changed. They spoke about household consumption growth, which has been particularly weak as inflation remains high, obviously affecting real disposable income. We'll look at the data in a second and we'll see that, okay, that's actually just been pretty much confirmed. So in my opinion, everything that they said last time around is pretty much in line with what they anticipated it would be. So let's look at the actual data then. Let's start with the inflation side. Last time around, they said that they think they'll only reach their target by the middle of next year. And they saw that inflation grew 3.6 instead of the prior quarter going into the end of last year of 4.1. Now, if we take a look at the actual data, yes, inflation surprised more than what the markets had anticipated, right? We printed at 3.6 for the weighted year over year instead of 3.4, up from the prior. But at 3.6%, with the year over year number at 3.8%, that is pretty much bang in the ballpark of where they thought regular inflation would be by the end of the second quarter, right? It's only trimmed mean inflation, which is substantially higher than what they thought, right? They thought trim would be 3.8, and we know trim came in at 4 spot, where's that number? Yeah, at 4.1%. But if you look at the year over year and the weighted number, there's no reason for concern. And more specifically, even though inflation did surprise higher at 3.6, right, looking at the weighted year-over-year number, we are still lower than the prior quarter that they were looking at. So we are still decelerating. We're just not moving as fast as they thought. And again, they have given themselves another year for that 3.6 number to get down to between 2 and 3%. So do I think this number surprises them? Do I think this freaks them out and forces them to shift more hawkish? I just don't think so. In terms of wages, they spoke about wages, saying that wages is a potential, concern for them. Wages came in lower than expected. Not massively lower, but at 0.8, it's the lowest going back to the middle of last year, which again should ease up some of the inflation concerns. The labor market is something that did come in better than what the markets had anticipated. If we take a look at the bank's expectations, they expected the unemployment rate to be at 4%. Now, where did the unemployment rate go with the prior print? Well, look at that, 4%. So should they be concerned about that? Not really. Full-time jobs did push up decently, right? They added 40,000 jobs. Do I think one jobs print, given its volatility, will be enough to freak them out? I don't think so. The fact that the unemployment rate is pretty much where they thought it would be, again, I don't see them wanting to change anything on the back of that. What about GDP? GDP came in below what the markets had anticipated, printing at, where's the GDP numbers? Here we go. Printing at 1.1%, which was below expectations for the quarterly number as well. It was, it showed a continued deceleration, the lowest growth going back to, 3 years before the pandemic. But at 1.1%, it's just below where they thought it would be, at 1.2. So yes, lower than expected, but not falling off a cliff. And again, not a number that should see them, freaking out and suddenly changing everything, shifting more dovish or more hawkish. So if we look at all of the incoming data and what they said last time round, not a lot has changed, which means that maybe their statement shouldn't have to change that much either. Now, there is, when you look at what they said last time round, I do think that the bank wasn't really honest with us in terms of how they portrayed the statement and then what they said in their minutes. Because in their statement, they said this line, which we thought would remain unchanged, that the path of interest rates that will best ensure that inflation returns to target in a reasonable time frame remains uncertain, and the board is not ruling anything in or out. When you say that you are not ruling anything in or out, you are saying that you've got no preference right now for hikes or cuts. Anything can go, right? But in the minutes, we know that in the minutes, the bank actually came out saying that, yeah, we actually talked about hiking rates, but you know what? We judged that the case for maintaining policy steady to be the stronger one. I'm like, wow, okay. So you actually spoke about hiking rates, but in your statement, you said that, you know what, we can go both ways. We can cut or hike. Anything is on the table. But you can't say anything is on the table if the one thing that you discussed to potentially do was hiking rates. You can't hike and cut at the same time, right? Unless anyway, that's me ranting about bank communication. And I'm not going to go into the reasons why I think there was a discrepancy there between the statement and the minutes. Maybe tomorrow we'll talk about that, but I'm not going to bore you guys with those details. The bottom line is, looking at all the data, looking at the recent statement, there's probably no reason for them to change this. Why? Because it gives them optionality. By just saying that, listen, we're not ruling anything in or out, cuts or hikes, it doesn't matter what the data comes in as. They can go either way. The data comes in too hot and they need to start shifting to hikes, they can go there from here. If the data collapses and they need to start shifting more dovish, they can go there from here. So why change that now? Why change that now when the data doesn't allow you or force you to? It just makes no sense. So I don't think the bank does much tomorrow. I think the statement remains pretty much unchanged, because that's what I would do if I was there in their shoes. I would just allow the data to speak for itself and say, listen, there's not been a lot of changes since the last time round, so we don't think we need to change anything this time. We can just basically kick the can down the road, so to speak. So that is why I don't think tomorrow will provide us with much of an opportunity. If there is an opportunity, right, it will obviously be in how they give their forward guidance to us. if they should change the statement that says the board is not ruling anything in or out, if they should change that to something more hawkish or more dovish, that is a potential trigger we can look for. What could a potential dovish or hawkish shift look like? Well, obviously, if they say the path of interest rates that will best ensure that inflation returns to target in a reasonable time frame is best suited for the bank to potentially lower rates, or best suited for the bank to be looking to hike rates in the months ahead, those could be possible ways they could shift that language, either more dovish or more hawkish. Again, I don't think that happens, but that is, in my opinion, really the only thing that they could do if they wanted to incrementally shift things. But again, it removes the optionality. I just don't see why they would want to do that. But those will be the key thing to look. That'll be the key thing to look at, is how that statement potentially changes, either more hawkish or either more dovish. Now, let's just say that we do get a more hawkish shift or do get a more dovish shift. What could we potentially look to trade? Let's start with a hawkish shift first, because that is, if there is going to be a shift, that's probably the more likely one to take place. And on that front, I think Aussie Kiwi upside could be potentially looked at. Why? Because the recent growth data for the Kiwi hasn't been great. We had the PMI surprise to the downside. That is putting some downside expectations going into GDP on Thursday. Furthermore, positioning, as we looked at earlier today, is pretty stretched for the Kiwi right now. This in itself is not reason to just short it, because fundamentally we do like it after the RBA policy decision, or have liked it. But if we do get a trigger like a very hawkish RBA, then maybe Aussie Kiwi could be on the card. Something to look at as a maybe short-term push, maybe back up towards that 108.30, maybe 108.40. I won't really be aiming for anything more than that on a hawkish shift. What about a potential dovish shift, right? If they do shift more dovish, what can we trade? What can we trade the Aussie against? Look, right now, it's risky because we know that the dollar is strong from a risk point of view, right? But we also know that the dollar probably should have been lower based on the PPI data and the CPI data that we had last week. So I am a little bit reluctant about this one. But you know what? If the RBA does shift dovish, as long as the dollar remains at the highs from last week and still supported by this time tomorrow morning, maybe Aussie dollar downside could be on the cards. We've got some key support coming in around that 65.80 level. It's the low going back to the 9th. It's the implied vol from today. Below that, we also have the 65.60, which comes in at the low from the 8th of May. And then below that, we've got the 65, let's just call it 6. It's a messy level. Let's just call it 65.20-ish. Around that area, which is pretty messy. Might be able to adjust that slightly. I mean, there's so many. It's a pretty messy level, this one. It's a pretty messy level. Let's just call it 65.20-ish, right? So I don't think we get there, even on a dovish shift though. That's very far. But again, I'm not a fan of wanting to buy the dollar right now, but that is a potential option to look at. Maybe, if overnight we get some really positive euro news on the political side. We have seen the euro being the strongest currency in today's session, purely on a bit of a bounce, you know, on the geopolitical or political fear that was priced into the markets. If you take a look at the amount of implied volatility price for euro pairs, it does look a little bit aggressive here. So if the euro is still strong by this time tomorrow, and it is a very dovish shift from the bank, then maybe Euro Aussie longs could be considered. We did push lower back down towards 61.50. We bounced quite aggressively from there. Right now, the pair is back above the 62.20, even making its way towards 62.70. So maybe if it's a very dovish shift, potentially aiming for 163 psychological, maybe above that. Back up towards that 163.80. Maybe there could be a case there for some upside. But again, I don't think we're going to get that type of shift tomorrow. Those are possible pairs we can look at, assuming everything stays as it is with a stronger dollar and a stronger euro, and obviously a weaker Kiwi. That is the pairs that would make sense. But again, guys, I'm not excited about trading this tomorrow morning. And unless it's an extremely clear shift, it's probably not going to be worth risking capital on something like that. But that's a preview for the RBA. As always, any questions, don't hesitate to let me know.